So friends, because of network issues, I have been unable to upload the videos of revision lectures. Please bear with us. And now I'm back with, and from today you will be getting a continuous videos. So come, let's continue with our Index 10 compiler. I have found only few questions, but which are already discussed as illustrations. Come, let's go through. In May 2019 RTP, this question has been given, but the same question ditto has already been discussed as an illustration while discussing the study material. If you want this question to be clear to you, please go through the previous video. Come, let's move on. And even in November 2019 RTP also the same has been given. This excise department, there is a dispute between the entity and excise department, and some order has been passed after the year end. Come, let's go through this question quickly. ABC Limited received a demand notice on 15th June 2017 for an additional amount of 28 lakhs from the excise department on account of higher excise duty levied by the excise department compared to the rate at which the company was creating provision and depositing the same. The financial statements for the year 2016-17 are approved on 10th of August 2017. In July 2017, the company has appealed against the demand of 28 lakhs, and the company has expected that the demand would be settled at 15 lakhs only. Show how the above event will have a bearing on the financial statements for the year 2016-17, where these events are adjusting, whether these events are adjusting or non-adjusting, and explain the treatment accordingly. Come, let's quickly go through this answer also. As per India's 10 defines that event after the reporting period as follows. Events after the reporting period are those events, favorable and unfavorable, that occur between the end of reporting period and the date when the financial statements are approved by the board of directors in case of company and by the corresponding approving authority in case of any other entity. In the instant case, the demand notice has been received on 15th June 2017, which is between the end of the reporting period and the date of approval of financial statements. Therefore, it is an event after the reporting period. This demand for additional amount has been raised because of higher rate of excise duty levied by the excise department in respect of goods already manufactured during the reporting period. Accordingly, condition exists on 31st of March 2017 as the goods have been manufactured during the reporting period on which additional excise duty has been levied, and this event has been confirmed by the receipt of demand notice. Therefore, it is an adjusting event. In accordance with the principles of Ind AS 37, the company should make a provision in the financial statements for the year 1617 at best estimate of the expenditure to be incurred, that is 15 lakhs. Hope you are clear with this question. This has been already discussed in our illustrations. I'll just brief out this question. It is saying that ABC Limited received a notice saying that additional 28 lakhs of excise duty has to be paid as the excise department has calculated the duty at higher rates. But ABC Limited is pretty well sure that the demand will be settled at 15 lakhs only, and this event, I mean this 28 lakhs payment has been confirmed by the excise department between the two dates, that is the date of balance sheet and the date on which the financial statements are approved. So it is an event after the reporting period, and this demand of 28 lakhs is relating to the goods that are manufactured during the year, and hence there also exists a condition as at the year end date which is confirmed by a receipt of demand notice. And since the ABC Limited is pretty well sure that the demand will be settled at 15 lakhs only, it has to make the best estimate of expenditure and disclose in the financial statements accordingly. Hope you are clear. And then comes May 2020 RTP. Even this is same, like same ditto as it is as an illustration which has been discussed. Hope you might be remembered that a specified turnover has to be exceeded to claim the duty drawback, and the prescribed time limit is 15 days. Same example, same thing has been given in May 2020 RTP also. Ditto, nothing else has been changed. We'll go through November 2020 RTP. Even this has been same ditto as it is from the study material only. That is the reason why I was revising all the study material content and the practice papers which are past papers, so that at least if there is any number change and if you are too lucky, the same question may be asked. Hope these videos are helpful to you. If you want these questions to be discussed again, please go through our previous videos. I will give you the link of those previous videos in the description box. And I had one more question to you, that while discussing Index 2 our compiler, we have noticed a question which is a combination of Index 2 and Index 10. Come, let's see whether that question is as same as illustration or whether that is a different question. We'll go through it once. Come, let me open. This is the question which we said that it will be discussed at the time of Index 10. Let's go through this question. On 31st of March, the inventory of ABC includes spare parts which it had been supplying to a number of different customers from some years. The cost of spare parts were 10 million, and based on retail prices at 31st of March, the expected selling price of spare parts is 12 million. On 15th April, due to market fluctuations, expected selling price of the spare parts in stock reduced to 8 million. The estimated selling price required to make the sales would be 0.5 million. Financial statements were approved by Board of Directors on 20th April 2001. And let's skip the second paragraph and we'll read the question. What is the required part? What will be the value of inventory at the following dates? That is on 31st of March 2021. And the second part is relating to the second paragraph. It is said that the cost of spare parts is 10 million. So as per Ind AS 2, inventory has to be valued at cost or NRV, whichever is lower. But after the year end, just after the year end, that is 31st of March, it is on 31st of March, cost is 10 million, NRV is 12 million. So what the ABC thought process, because cost is lower, we'll record inventory at cost, that is 10 million. But just after the due year end, that is on 15th of April, due to market fluctuations, the selling price of spare parts got reduced to 8 million. And the estimated selling price is estimated cost to make sale is 0.5 million. So then the NRV as on 15th March, that is after the reporting period, is only 7.5 million. So now the company is confused whether to value inventory at 10 lakhs or at 7.5 lakhs, because the event of market fluctuations has occurred between the date of financial statements getting approved and the year end. So the ABC is Limited is asking whether this is an adjusting event or not, and if yes, if this is an adjusting event, then what will be the value of inventory. So it is very clear from the question that it is an adjusting event, because inventory is already, the condition is already existing as on the year end, as on the last date of year, and hence this has to be an adjusting event. And as on 31st of March 2021, inventory has to be valued at 7.5 lakhs, because as per Ind AS 2, it is cost or NRV, whichever is lower. So The NRV is 7.5 million, the same has to be written. And the balance 2.5 has to be charged to income statement. Come, let's go through this solution. As per Ind AS 2, inventory is measured at lower of cost or net realizable value. Further, as per Ind AS 10, decline in net realizable value below cost provides additional evidence of events occurring at the balance sheet date and hence shall be considered as adjusting events. So it is as per Ind AS 2, cost or NRV whichever is lower, and as per Ind AS 10, if there is an additional evidence that specifies that the condition is already existing on the balance sheet, that is an additional proof, then it has to be an adjusting event. Check. In the given case, the valuation of inventory as on 31st of March, cost of inventory would be 10 million and the net realizable value would be 7.5 million. That is the expected selling price of 8 lakhs minus the estimated selling expenses of 0.5 million. So the net is becoming to 7.5 million. Accordingly, inventory shall be measured at 7.5 million. That is lower of cost and net realizable value. Therefore, inventory written down of 2.5 million would be recorded in income statement for that year. Hope you are clear with this question, this part of the question. Come, let's go through the next part. Second part of the question. As at 31st of March 2022, directors noted that such inventory is still unsold and lying in the warehouse of a company. Directors believe that inventory is in a sellable condition and active marketing would result in an immediate sale. Since the market conditions have improved, estimated selling price of inventory is 11 million and the estimated selling expenses are 0.5 million rupees. And now the question is asking what will be the value of inventory as on 31st of March 2022. Hope you are clear here. In the second case, the NRV is 11 million minus 0.5 million, which is 10.5 million. And the inventory is carry forward to the next year as 7.5. Now see, cost or NRV, whichever is lower. Say that the cost is 7.5 million and the net realizable value is 10.5 million. Whichever is less means inventory has to be valued at 7.5 million. But this thought process is completely wrong. It is absolute rubbish. The cost of this inventory is 10 million. The 7.5 million which you are discussing is the carry forwarded value. It is the written down value. Hope you are clear with this. In the second year, the cost is 10 million and the estimated selling price is 10.5 million. So whichever is less means cost has to be taken into consideration. That is 10 million. So inventory has to be valued at 10 million. But the value which we are carrying forward is 7.5 million. So there is a difference of 2.5 million. Again, the treatment should be given for this 2.5 million. Hope you understood this point. I'm repeating it again. In the second part of the question, you should consider the cost of inventory as 10 million but not 7.5 million. This 7.5 million is the carry forwarded value of inventory. This is not the cost. And as the market conditions have improved, now the net realizable value has become 10.5 million. How we arrived at this 10.5 million? It is 11 million minus the estimated selling expenses of 0.5 million. So we arrived at NRV of 10.5 million. Now applying the Ind AS 2, we will get the value of inventory as 10 million because cost is lesser than the net realizable value. Come, let's go. Hope you understood this point. Come, let's go through the solution slowly. As per Ind AS 2, a new assessment is made of net realizable value in each subsequent period. It states that if there is increase in net realizable value because of changed economic circumstances, the amount of written down is reversed so that new carrying amount is the lower of cost and the revised net realizable value. Accordingly, as at 31st of March 2022, again inventory would be valued at cost or the net realizable value, whichever is lower. In the present case, cost is, sorry, it is written as 1 million, it is 10 million, it has to be 10 million. In the present case, the cost is 10 million and the net realizable value is 10.5 million. That is, estimated selling price 11 million minus the estimated selling price of 0.5 million. Accordingly, inventory would be recorded at 10 million and inventory written down carried out in previous year of 2.5 million shall be reversed. Hope you got this point very clearly. And once again, I'm saying that in the present case, the cost is 10 million. It has been mistyped or misprinted as 1 million. Hope you are clear with this question. This is easy question, but a bit tricky in the second part of the question. First part, everyone will do. In the second part, you should be very careful while considering the cost of inventory. Hope you are clear with this. And by this we have completed our Ind AS 10 compiler. We'll continue with the new Ind AS tomorrow. Hope you guys are following, and if you have any doubts, please comment below. And if you want me to discuss any particular topic in detail, comment below. And please note that these are revision lectures. You will get complete revision classes for May 2021 examinations, whereas Jan 2021 examination attempt students can also follow these, but please be prepared for Jan 2021 examinations. You won't be getting complete like all subject revision classes, but if you are a Jan 2021 student, please comment below which topic you want me to discuss earlier, so that I will discuss and we'll complete it over there. Hope you are clear with my point that these are only revision lectures. This is not a complete full-fledged classes which are going here. Hope you guys will support me, and if there are any students who are planning for both groups in May 2021 examinations, and if you people want me to discuss this group 2 subjects also, please comment me. If you people encourage me to do more videos on CA revision, all subjects, I will be doing it, but I need your support and encouragement. Hope these videos are helpful to you. Thanks for watching. If you like the video, please like, share and subscribe. Hit the bell icon to get the instant notifications. And from now, there won't be any disturbances. You will be getting FR and law classes daily. FR will be on at 11 a.m. and you will get law classes maximum by 3:34 in the evening. There won't be any disturbances from now, and thanks for bearing with us. Bye bye.